This is Money Talks. I'm Greg Vogel, Portfolio Manager at GKV Capital Management. U.S. stock market returns have been fantastic for the last decade. The S&P 500 has returned more than 15% annually since 2016. But it's been the last 3 years that the market has been on fire, returning more than 20% annually. It's not the U.S. economy that's driving the gains. It's growing, but not nearly as fast. U.S. GDP is up 5.7% annually since 2022. If you account for inflation, real growth is less than 3% a year. Looking deeper at stock performance by industry sector, you'll quickly see that the big gains are limited to technology. Communication services and tech sectors have 3-year annual returns of more than 30%. Everything else is less than half that performance, with the exception of industrials, which are up 21%. Something happened at the end of 2022 to ignite the rally. On November 30th, OpenAI released ChatGPT. Is there still investment opportunity, or are we headed for another tech bubble? Right now, AI is driving almost all of the stock market gains. Truly revolutionary technologies don't come along very often. The last event was the launch of Netscape Navigator on December 15th, 1994. Look at the 8 most valuable companies in the world. 3 of them, Amazon, Google, and Meta, didn't even exist prior to that launch. 4 more are tech giants, NVIDIA, Microsoft, Apple, and Taiwan Semiconductor, which benefited tremendously by the advent of the internet. That's 7 out of 8. If you invested early in these companies, you made serious money. And that's got everyone asking, is AI the next internet? Think about the internet for a second. It's been about 30 years since it went mainstream. Can you even imagine life without it now? Everything you do on this device depends on internet connectivity. Checking email, social media, streaming, ordering food, banking, calling an Uber, really everything. We think AI is going to be the same way in 30 years. It'll be woven into absolutely everything we do. Sounds like a slam dunk investment, right? Well, not so fast. Here's where things get tricky. Even when you know a technology will be huge, picking the winners and getting the timing right is really, really hard. Let me tell you a story about Amazon. From January 2000 to the end of 2001, during the dot-com crash, Amazon lost 90% of its value. 90%. Imagine you bought Amazon stock, watched it drop 90% and sold it in a panic in 2001. You'd have locked in massive losses and missed out on what came next. After that crash, Amazon recovered and then generated 27% annual returns for the next 25 years. If you held on through the dark days, you became wealthy. The lesson? Even the right investment can feel very wrong before it feels right. Right now, the big tech companies, the hyperscalers as they're called, are spending massive amounts building AI infrastructure. We're talking data centers the size of city blocks. In 2023, combined spending of around $150 billion. In 2025, $380 billion, more than double. And the estimate for 2026 is for $660 billion. This is what's driving sales for companies like NVIDIA and Broadcom. All those chips, memory, storage, and power supplies have to come from somewhere. But here's the million-dollar question. Is this the right amount of spending, or are we building too much too fast? Now let's look at history, because we've seen this movie before. In the 1800s, railroads were revolutionary, a completely new way to move people and goods. Investors went crazy, but they built way too many rail lines. Most of them never made money, and investors lost their shirts. Same thing happened with the internet. Remember WorldCom? They built out way more data bandwidth than the market needed. The company collapsed, and investors lost billions. The pattern is clear. Revolutionary technology plus investor excitement equals risk of building too much too soon. There are still some huge question marks with AI. Will AI companies have profit margins like traditional tech companies, 25% or more? Or will they look more like utilities and industrial companies, around 12%? That's a massive difference for investors. AI is going to change jobs and industries. Think about what the internet did to travel agents. They basically don't exist anymore. Taxis became Uber. Newspapers went online. AI will do the same thing, but we don't yet know who gets eliminated and who wins. So what should you do as an investor? Well, you should invest in the AI opportunity. This technology is real and transformative. But don't put all your eggs in one basket. Here's the smart approach. Diversify across sectors. Yes, own some AI and tech stocks, but also own healthcare, financials, consumer goods. Spread your risk. Go international. Own stocks from other geographies. This protects you if the dollar weakens. Different economies grow at different times, and right now foreign stocks are trading at a discount. Diversify asset classes. Stocks are great, but they're volatile. Add bonds for stability. Consider real estate, maybe some commodities. The goal is to capture the upside of AI without betting your entire future on it. Look, AI is probably going to be huge. In 30 years, we might not be able to imagine life without it, just like the internet today. But getting from here to there is going to be bumpy. There will be crashes, there will be companies that fail, and there will be times when it feels like the sky is falling. The investors who win are the ones who believe in the technology, invest wisely and diversely, can stomach the volatility, and most importantly, don't panic and sell at the bottom. Remember the Amazon investors who held on through that 90% crash? Those are the people who built wealth. Investment opportunity in AI is tremendous, but returns will not be in a straight line. For more detail on our analysis, you can download our quarterly update at gkvcapital.com. We are an independent investment advisor. We build portfolios to meet the individual needs of our clients. Get in touch with us and we can show you what we can do for you. Thank you very much for watching.